All right, hey everybody, this is John, and tonight I wanted to share with you the best way to play earnings. So here is a stock, Zscaler, that's got earnings coming out today after the close. And if we look at this, a couple key things I like to look at is what did it do the prior to earnings, okay? And so you can see here, kind of a little move up and then kind of did nothing. And then this earnings, it had a big move, went from like 260 up to over 300. All right. And so I always like it when I see something like this. If you see a little move over here and then the next one's like this big move, typically then you can take that average and that'll often be the move of the next earnings. Okay, so that's the next earnings coming up today. Now, here's the thing is you don't know if that move's going to be up or down, right? And generally, when you're playing earnings, what'll happen is if you buy a call like up here or you buy a put down here, a lot of times it's designed to expire worthless unless it's one of those rare moments where this is incredible move to the upside or incredible move to the downside, but that just doesn't happen as much. So what do you do? All right, so here is Zscaler, and you can see that one of the nice things here, and this is on Thinkorswim, but you can do this on anything, is that it's saying that the expected market maker move for the next day is $26.69, and that's based on things like the implied volatility, the fact that you've got earnings. They know that things are going to get a little whippy, so you're paying higher price for options that expire this week than say like next week or the week after. Okay, so you can see that those implied volatilities are pretty low. This one's pretty high. And the one thing that we all know is once earnings are done and once they're out, this implied volatility will drop to these levels. So these option prices will also drop almost immediately. This is why, if you think it's going to go up and you buy like say a $300 call, in this case for $5.70, and then it goes up to exactly where you thought, $300, you'll actually lose money simply because this will drop, this IV will drop, all right? Okay, so now the other thing is we don't know necessarily if it's going to be up or down for sure, right? We don't know with 100% certainty, although we could kind of, maybe it'll be good. But the main thing here as I look at is that the market is pricing in for after earnings a plus or minus move of $27, and then for the week the market makers are pricing in a move of plus or minus $28. So what I like to do in situations like this is just simply bet that the market makers are right. Okay, last earnings you had a little move, next earnings you had a big move, and now they're kind of pricing in a big move, but it's really going to be, typically it's going to be the average of these two. So here was a move that was $10, here's a move that was $30. You take the average of that, that's about $15. Well, they're thinking it's going to be, they're already pricing in $26. So they're already pricing it as if it's going to be $26, but we're looking for only $15. So what I want to do is essentially make a bet that they are right and we are indeed going to trade inside of that range. And so what I'll do then is that, Zscaler is around $275. So we sold the $275 call, which is like $14, sold the $275 put. Now, of course, we don't want to do that naked. You can do that naked, but then what happens, it just opens you up to a lot of, maybe stress and anxiety because what happens if it goes up $100, right? So this way, what you can do is just kind of put a cap on that. And what you can do in this case then is buy. What I like to do is I'll buy something that's outside of both this range and the week's range. So in this case, $30 out. So if I'm buying the $275 calls, I will sell the 305s against it. And then if I'm selling the 275 puts, I will go down $30. I think it's the 245s. All right, so what does that look like? So here's what that looks like. So on a one lot trade, you are selling the 275 call and you are selling the 275 put, and then you're buying protection. So in this case, you're getting a total credit of $20.76. Of course, it's not going to be, unless you do it naked or much wider, you're not going to be right up to this, but you want to get pretty close. Like I wouldn't do this $10 wide because then it's just like, you're not really, it looks more attractive, but you're not really giving it, much of a chance. So then let's take a look and see what happens when the earnings come out. And so the earnings have come out, and so you never really know exactly how what's going to go down. So we were at 275. You can see the earnings came out and initially spiked up to 305. Okay, so 275, 305 minus 275, that is $30 if I'm doing my math right. And the expected move for the day was $26. The expected move for the week was $28. Now, what will happen in most cases, of course not all, because sometimes earnings can just keep on ripping, as we've all seen, or they can implode. But in many, many cases, even if it'll tend to poke the range to the upside or the range to the downside, and then kind of find a nice middle ground. Now, it's after the close. It's almost 4 o'clock Central, so I don't know exactly where this Zscaler is going to open. But right now, what we've done is we sold the 275 call and the 275 put. We've been up to 305. Right now, we're at like 285, 284, or something like that. So if that's the case, if we open here, we'll make an immediate profit at the open. Now, a lot of things can happen between now and the open. It could certainly turn back up. It could turn back down. But the idea on something like this is we're not trying to, everybody gets so excited when they buy an option at 1 and then they sell it at 4 and they get all excited about, oh, I got this huge percent return. Yeah. Okay. And that's great. And it's great when that happens. Don't get me wrong. But it's so much easier because you got to really focus on the net. If you did one contract on that and that worked, then congratulations, you made 3 points. That's $300 profit. Now, if you sell one at 20, okay, and you're able to buy it back at 17, you also made $300. And guess what? It's a lot easier to sell something at 20 and buy it back at 17 with premium decay in your favor than to consistently find stuff that goes, buy it at 1, go to 4. So that's a long way of saying that what's your target on something like this? Typically, I'm looking on something like this to buy it back. If I sold it at 20 and if I could buy it back at 15, that's great. But typically, I'm looking at about 35% of the credit received. Okay, so if I sold it for 10, that means I'd be buying it back at 750, et cetera, right? So anyway, so the easiest way to calculate this, and it is really just based on a percentage. And so if you come over here, so let's say it's, we got it for $21 and we are fine taking a profit at 30% of the credit received. So you might think initially it's like, well, what if I do times 0.3? Okay, then is my target $6.30? No, it's going to be $21 minus $6.30. So the easier way to do this, of course, this is when that one math class from 3rd grade comes in handy, is you do $21, click that, right? $21, and then just multiply it by, instead of dividing by 0.3, you just multiply it by its opposite, 0.7, boom, and that gives you your target. So my default target for tomorrow on this will be $14.70. Now, one thing I've found is that it's a good idea just to do that after the close and then do it, or at least before the open, and then just do it as a GTC order. Obviously, if you do it after the close. So that way it's working right at the open. And I think this is one of those things where, you don't want to sit there and like wait and, oh, is it going to get better or not? Just have this order working at the open. And, see if that's something that can get filled fairly quickly. And if not, that's fine. You may have to adjust. My rule of thumb for this, in this case, as long as it's kind of tending to trade in between, you can look at the, if it's trading plus or minus $20 from that 275 level, that's fine. It's basically what you're looking for is that it trades within that expected move. So the expected move is $26. As long as it stays plus or minus $26 from your entry at 275, that's fine. You can kind of give it a little bit of time. If for some reason though it powers through, 305, $30 up or $30 down, and then you just kind of take it off. The nice thing about it is because it's not, it's still got till Friday expiration, you're not going to get out with a max loss if you follow that rule. You might get out, you might lose 3 or 4 points on it. That's fine. So essentially on something like this, you're looking to risk 1 to make 2. So we'd like to make, about give or take a little more than $6 on the trade. So we're willing to risk about $3 on that. All right. Okay. So hope it helps. You can check out the link in the description for more info on our Labor Day sale. And hopefully that earning trade you found helpful, and good luck on your next earnings trade.
Hey, John here with Simpler Trading. Thanks for watching. If you enjoyed this video, comment down below and let us know what topic you want to see us cover next. Also, be sure to subscribe and click the bell icon so you can get notified when we release new videos. And if you want to watch us trade in real time using our own money, go to simplertrading.com and learn how to sign up. Good trading, and we'll see you next time.